being globally active is important. You can still, when we step back and look at the global bond market, it's a huge place. It dwarfs the market capitalisation of the equity market. People get fixated on certain pockets of sovereign yield curves that are negative, but certainly we're finding plenty of opportunities to construct portfolios that still provide that defensive nature and are still providing healthy levels of real income. For our clients, they want those two characteristics of providing that defensive, diversifying portfolio that does well when they're either risky portfolios or risky assets don't, and then opportunities to provide real income that everyone's searching at the moment. So when I look at that, you really have to be global. You're running out of assets in Australia that are providing that. Obviously, the government curve doesn't do that anymore for you. You can't really sit in, you can't really sit in cash or bank TDs anymore to get that positive real return on cash either. So you've got to look globally, and there are plenty of opportunities at the moment. If I look at opportunities in Australia, the government curve is low and generally below inflation right across the curve, but you don't have to take much more risk to get a positive return and still have that sort of diversifying characteristic. So an example of that is just long-dated state government bonds. It's not the federal government, it's the state government. They're still AAA or AA rated. And those long-dated yields are still comfortably earning more than inflation. So, that's an example of still buying an asset that has that defensive characteristic that's giving you a real return, so a positive return after inflation. You can still get that from US Treasuries. At the moment, and we're not used to it, but at the moment, US interest rates are still much higher than Australia. And if we go through a volatile period or a period where the global economy doesn't do so well, that's one of the only central banks around the world now that can actually lower interest rates a lot further and support bond prices. So there's still plenty of opportunities for those defensive characteristics. And then when you're looking for portfolios, when you're looking for assets to provide that strong, positive, real return or real income, we're finding opportunities there too. One example would be global financials. You can still construct a portfolio of bank bonds across the capital structure from senior down to sort of tier 1 and tier 2 bonds, and you can construct a globally diversified across names that everyone would be familiar with, the big global banks, across the capital structure, hedged back to Aussie dollars, yielding somewhere around 4%. Versus an inflation rate of about 1.5%. So there's still plenty of opportunities. As I say, you have to be global. That helps a lot. And you sort of, the portfolio construction process of combining the income generating assets with the defensive assets is important as well.